Welcome to the deep dive. We're looking today at AU Bank. Quite a transformation happening there.
Absolutely. You shared some great sources covering their journey from that specialized finance company background, right?
Yeah, exactly. And then becoming India's first small finance bank, an SFB, to actually get the nod for universal bank status. That's big news.
It's huge. So our mission today really is to unpack what's going on. They've made two massive strategic moves.
The FinCare merger and the universal bank license.
Right. And we need to figure out if these moves can fix what seems to be, well, a core structural weakness in their model.
Because if they can pull it off, the potential is there for maybe a decadal investment story.
That's what the sources suggest, yeah.
Yeah.
It's a fascinating setup. Okay, so let's get into it. AU Bank. It's kind of a tale of two cities, isn't it?
It really is. On one hand, you have this incredible strength. Let's call it the AU DNA.
Uh-huh.
They've been doing specialized secured lending since '96. Think wheels, micro business loans, and their niche is that hard to underwrite customer.
The self-employed folks, often in, rural or semi-urban India, SURU areas, places the big banks often avoid.
Exactly. And that specialization, that's their moat, right? Gives them significant pricing power on their loans.
Definitely. They maintain really high yields because of it. We saw what? Q1 FY25 new yields hitting 15.8%. Pretty impressive.
And this is the other side of the city, that strength on the asset side is sort of forced to compensate for a big weakness.
The liabilities.
Their funding.
Yeah. As an SFB, a small finance bank, they just don't have that brand trust, that nationwide recognition like the HDFCs or ICICIs.
Which makes them a price taker for deposits. They have to offer higher rates to attract savers.
Right. So they're stuck with this perpetually high cost of funds, projected near 7.1%, I think.
Around there, yes. And consequently, a low CASA ratio. For you listening, CASA is the cheap current account and savings account money. AU's ratio is stuck around 29-31%.
So expensive borrowing. The whole business model is basically this arbitrage, right? High-yield assets making up for high-cost liabilities. That's the core structure. So the deep dive question is, can these two big recent events actually fix that liability problem?
Okay, let's tackle catalyst number one, the FinCare merger. This happened April 2024, and initially, it looked painful, market wasn't happy, NPAs went up.
Yeah, there was definitely some pessimism. But here's the interesting find from the sources. This merger wasn't about AU suddenly pivoting into high-risk microfinance, which is what FinCare was known for.
Oh, so not chasing MFI.
No, in fact, management seems to be actively shrinking that acquired unsecured book. It was down like 20.3% year-on-year in Q1 FY26 data.
Okay, so what were the real prizes then? Why do the merger?
Two things mainly. First, the Pan-India distribution platform. FinCare gave them a much stronger foothold, especially in South India, where AU was weak.
Geographic expansion. Makes sense.
And second, maybe even more importantly, a regulatory buffer for priority sector lending, PSL. SFBs have a really strict 75% PSL target.
Right, lending to specific government-mandated sectors.
Exactly. FinCare was already at about 85% PSL compliance.
Yeah.
Merging helped AU meet that tough 75% target more easily. It bought them breathing room.
So the cost of getting that distribution and PSL buffer was basically absorbing FinCare's, let's call it, credit cost time bomb.
That's a good way to put it. The spike in gross NPAs peaking around 2.47% in 2024, 2025, that was the predictable pain of digesting that higher risk book.
Yeah.
It was digestive, not, existential for AU's core model.
Okay, digestive pain. That makes sense. Which brings us to catalyst number two, the Universal Bank License Approval, August 2025. This feels different.
Oh, it's absolutely different. This isn't just tweaking the model. It's a fundamental change in identity. The RBI approval is potentially a game changer.
Why? Because it gets rid of the small bank perception. It helps with the cost of funds eventually.
That's part of it. The branding and trust factor should improve over time.
Yeah.
But the immediate quantitative impact is the regulatory unlock. It's huge.
Talk about that unlock, the number.
Okay, so remember that tough 75% PSL requirement for SFBs?
Yeah.
As a universal bank, that requirement drops precipitously. It goes down to the standard 40% level that applies to all the big banks.
Wait, from 75% to 40%? That's a 35 percentage point difference.
Exactly. Think about what that means. It effectively frees up 35% of their entire loan book. They no longer have to allocate that chunk to mandatory PSL sectors.
So they can reallocate that capital where?
Into higher margin, non-PSL lending, commercial banking, corporate loans, you name it. Areas where they can potentially earn more. It structurally diversifies their risk and gives margins a significant boost almost overnight. Plus, the minimum capital adequacy ratio, CRAR, also drops from 15% for SFBs to 11.5% for universal banks.
Freeing up even more capital for growth. Okay, that sounds almost too good to be true. A guaranteed structural fix.
Structurally, yes. The regulatory change itself is locked in. But, and this is a big but,
There's always a but. Execution risk.
monumental execution risk. The sources highlight this clearly. Management is juggling a lot right now. They're integrating FinCare systems, potentially moving headquarters, dealing with the lingering asset quality digestion, all within roughly an 18-month window. It's a real danger zone.
So, what's the absolute killer risk here? The thing that could derail this whole story? What should you, the listener, really watch?
The most alarming scenario, the real bear case, is if the asset quality stress we saw from the FinCare book starts to leak out
Leak aware.
into AU's own newly originated loans, particularly in the new geographies. We're seeing some maybe early warning signs in their secured mortgage portfolio down in South India.
Okay, that's worrying. Because their whole DNA, their underwriting moat, was built in North and West India.
Precisely. So the critical question becomes, does that specialized underwriting skill, that AU DNA honed over decades in their home turf, actually travel well? Can they replicate that success nationally?
If it doesn't travel, then the whole geographic expansion thesis, which was part of the FinCare rationale.
It kind of falls apart. That's the core risk to monitor. Can they scale their secret sauce?
All right. So, putting it all together, we have these powerful catalysts, especially the universal bank license, but also serious execution risks and this question mark over scaling their core competency. How do we weigh this?
Well, you have to look at management's track record. It's pretty strong. They've delivered, what, a 25.6% profit CAGR over the last 5 years, navigating the SFB constraints. That counts for something.
And there are some positive signs recently.
Yes, the latest data available, Q2 FY26, did show some stabilization. Slippages, which are new bad loans, actually declined 12% from the previous quarter. That supports the idea that the current crisis is more digestive from the merger, not something fundamentally broken.
Okay, so the verdict.
Look, it's a high-stakes situation, no doubt, but the underlying story seems to be a structural, potentially decadal growth opportunity. The regulatory fixes from the universal license are robust. Barring a major execution fumble, we could realistically project a minimum 5-year earnings AGR in the, say, 20-25% range.
So a final thought for you listening. The universal bank license is a powerful, almost guaranteed structural fix for the liability side of AU's business. That's a huge de-risking event. But the ultimate success still hinges on execution.
Can they migrate the C-suite, the IT platform, smoothly? And critically, can they prove their specialized lending DNA works just as well outside their traditional strongholds?
That's the core business risk that remains. The crisis looks digestive now, but watching how they execute the scaling plan quarter by quarter, that's essential.